In 1971, a man named Nixon walked to a podium, said 41 words nobody understood at the time, and quietly ended an era. He didn't raise your taxes. He didn't cut your paycheck. He didn't send you a letter. But by the time you finish watching this video, you'll understand how that one afternoon has been costing you money every single day since. Not through a bill, not through a fee, through something far quieter. We're going to call it the hidden tax. And unlike every other tax you've ever paid, nobody voted for it, nobody collects it, and almost nobody explains it properly. Stick with me, because once you see this mechanism, you cannot unsee it. It's sitting in your bank account right now, working against you, while your bank statement tells you everything is fine. Let's open the hood. Here's a question. If you put $1,000 in a savings account today, and you don't touch it for 10 years, do you have more money or less money? Most people say more. The number on the screen goes up. Interest gets added. Feels like growth. But that's the trick. That's the whole trick. Because the number is not the same thing as the value. And almost nobody is taught the difference. Let's do something uncomfortable. Let's actually check. In the year 2000, a movie ticket in the United States cost around $5.40. Today, it's closer to $11. A basic loaf of bread that cost around $1 now costs closer to $2.50. Rent, if you've paid rent in the last 5 years, you already know where this is going. Your $1,000 from 2000 is still $1,000 in your account. But it buys roughly half of what it used to buy. Nobody took it. It just quietly stopped being enough. That's the hidden tax. It's called inflation. But calling it inflation is where most explainer videos stop, and that's exactly why most people still don't understand what's actually happening to them. Inflation isn't weather. It isn't some natural force like rain or wind that just happens to money. It is a decision made repeatedly by people in rooms you will never be invited into. And once you understand who makes that decision and why, the entire system stops looking like an accident and starts looking like a design. So why does this matter right now? In a way, it didn't matter 20 years ago. Because the pace changed. For most of the last century, this hidden tax moved slowly enough that people barely noticed it, the way you don't notice a glacier moving. 2% a year quietly in the background. Annoying but survivable. Then in 2021 and 2022, the glacier started sprinting. Inflation in the United States hit levels not seen since the early 1980s. Wages, for most people, did not sprint with it. And suddenly millions of people who thought they were doing everything right, saving diligently, avoiding debt, watching their bank balance climb every month, looked up and realized they were quietly losing ground the entire time. This is the part that should unsettle you. You can do everything your parents told you to do. Work hard. Spend less than you earn. Put money away. And you can still end up poorer in real terms because the ruler you're using to measure your progress is shrinking while you're not looking at it. That's not a personal failure. That's a design feature. Let's talk about why the design exists at all. To understand the mechanism, you have to go back further than Nixon. You have to go back to a basic problem every government with a currency eventually faces. Money is a promise. When a government issues currency, it's essentially saying this piece of paper or this number in a database represents real value, and people will accept it in exchange for real things. Bread, labor, land. For that promise to mean something long-term, there has to be some kind of restraint on how much of it gets created. Historically, that restraint was physical. Gold. You couldn't print money you didn't have gold to back, at least in theory. In August of 1971, that restraint was removed. The United States stopped allowing its currency to be converted into gold. This is the moment we opened with. 41 words on television, and the last physical leash on money creation was cut. Since then, and this is true of nearly every major currency in the world, not just the dollar, money is what economists call fiat. Its value exists because of trust and law, not because it's backed by a fixed physical thing. Here's why that matters to your savings account. Once the leash is off, the temptation to create more money never fully goes away. Governments have wars to fund, promises to keep, crises to manage. Central banks have mandates to keep economies from collapsing. And the easiest lever to pull, easier than raising taxes, easier than cutting spending, easier than telling voters uncomfortable truths, is to create more currency. More currency chasing the same amount of goods means each unit of currency is worth a little less. That's the mechanism. It is not complicated. It is almost insultingly simple once you strip away the jargon. The complexity isn't in the concept. The complexity is in how well it's been hidden from the people it affects most. Now let's get into the actual math, because this is where it stops being an idea and starts being personal. Let's say inflation runs at an average of 3% a year, which is roughly the long-term historical average for the US dollar over the past several decades. Sometimes lower, sometimes dramatically higher. At 3% a year, prices double roughly every 23 years. That means if you're 30 years old right now, by the time you're 53, you will need roughly double the income just to maintain the exact same standard of living you have today. Not a better one. The same one. If your savings sit in a regular account earning close to zero, or in cash under a mattress, that money is losing purchasing power the entire time, even while the number printed on your statement stays flat or creeps up slightly from token interest. Here's the part that should genuinely bother you. Banks are not villains for this. They're playing an entirely different game. When a bank offers you an interest rate on your savings, that rate is usually set with reference to central bank policy, and it is almost never designed to fully outpace inflation. Historically, in most years, the interest offered on basic savings accounts sits below the inflation rate. That gap, the space between what your money earns and what prices actually rise by, is where your purchasing power quietly leaks out. Nobody sends you an invoice for this. There's no line item on a receipt that says, inflation tax, $40. It just shows up as things costing more, as your paycheck stretching less far, as a strange nagging feeling that you're working just as hard but somehow falling behind. That feeling is not in your head. You are running on a treadmill that someone else is quietly speeding up. Now here's where it gets uncomfortable in a different way. Inflation doesn't hit everyone equally. And this is the part almost no mainstream explainer wants to sit with because it's a little bit ugly. If you own assets, real estate, stocks, businesses, inflation can actually work in your favor. Asset prices tend to rise with or even ahead of general inflation. A house bought with borrowed money in an inflationary environment often becomes easier to pay off in real terms over time, because your mortgage payment stays fixed in dollar terms while your income, and the value of the house itself, tends to rise with inflation. But if your wealth sits mostly in cash, in a basic savings account, in a paycheck that doesn't keep pace, inflation acts like a quiet transfer of value away from you and toward people who already hold appreciating assets. This is the uncomfortable irony sitting at the center of the whole system. The very tool that's often framed as necessary for economic stability, mild ongoing inflation, ends up functioning as a slow redistribution mechanism. Away from savers, toward asset holders. Away from the cautious, toward the leveraged. Nobody designed this maliciously in some smoke-filled room, at least not usually. It's more like a side effect that never gets fixed because the people with the power to fix it are often the ones benefiting from it staying exactly as it is. Let's contrast the story you're usually told against what's actually happening, because the gap between the two is where most people get quietly misled. The story you're usually told goes something like this. Save your money. Put it in a bank. Interest will help it grow. Be responsible and the system will reward you. The reality is closer to this. Save your money in a basic account, and in most years you are not growing your wealth. You are slowing down its erosion. There's a meaningful difference between those two sentences, and almost nobody says the second one out loud on television. This isn't a conspiracy theory. It's published data. You can look up historical inflation rates next to historical basic savings account interest rates for almost any decade, and in most years the gap runs in the same direction. Prices rise faster than what a saver typically earns holding cash. The absurd part, the part that would almost be funny if it weren't your actual money, is that the entire system is often marketed using the language of safety. Savings accounts are called safe. Cash is called safe. And in one very narrow sense, that's true, you won't lose the number. But the thing the number is supposed to represent, your actual buying power, can be quietly draining the whole time you're being told you're being responsible. Safe from what exactly is the question worth sitting with. So why does this system keep running, decade after decade, if it's this lopsided? Because a small amount of steady inflation is genuinely useful for parts of the broader economy. It encourages spending and investment rather than hoarding cash. It gives central banks room to lower interest rates during downturns without hitting zero too quickly. It makes debts, including government debt, easier to manage over time because a debt of a fixed dollar amount becomes smaller in real terms as the currency loses value. That last point deserves its own moment because it's easy to miss. Governments around the world, including the United States, carry enormous amounts of debt, in the tens of trillions of dollars. That debt is denominated in a currency the government itself has significant influence over. A little inflation, sustained over decades, quietly shrinks the real burden of that debt. Put plainly, inflation doesn't just erode your savings. It also erodes the government's obligations. The same mechanism draining your bank account is, in a very real sense, doing a portion of the same work for the entity that helped set the mechanism in motion. This isn't a wild accusation. It's a well-understood, openly discussed dynamic in economics, sometimes referred to as inflating away debt. It's simply rarely explained to the public in the same breath as why is my grocery bill so high? Let's zoom all the way out because this is bigger than one country or one decade. Almost every major economy on Earth now runs on a fiat currency system with some target rate of ongoing inflation. This isn't unique to the United States. It's closer to the global default setting since the gold standard era ended, which means the hidden tax isn't a flaw in one particular system that a smarter government could simply avoid. It's closer to a built-in feature of how modern money works almost everywhere. The specific rate differs. The honesty about it differs. But the underlying mechanism, currency losing value over time relative to real goods, shows up almost universally. This has real consequences for how people plan their lives. It means the old advice, work hard, save diligently, keep your money safe in a bank, was built for a slower, gentler version of this mechanism that existed decades ago. In a world where the hidden tax can spike unpredictably, as it did in 2021 and 2022, that advice alone is no longer sufficient protection. It also raises a much larger and more uncomfortable question about fairness. If the system quietly rewards people who already hold appreciating assets, and quietly penalizes people who hold cash out of caution or necessity, then the hidden tax isn't just an economic mechanism. It's functioning as a wealth-sorting machine, running in the background of everyday life with no ballot box and no way to opt out. Here's what I find genuinely strange about all of this. We live in a world obsessed with visible costs. We compare prices before buying a coffee. We clip coupons. We negotiate salaries down to the last $1,000. But the single largest, most consistent drain on ordinary savings, over a lifetime, often isn't a bad purchase or a bad negotiation. It's simply holding cash, quietly, doing nothing, while prices move on without it. And the strangest part is how invisible the whole thing remains, even now, even after 2021 made it briefly impossible to ignore. Within a year or two, the headlines moved on. The conversation shifted back to interest rates, to stock picks, to the next crisis. The underlying mechanism, the one that never actually stopped, quietly went back to running in the background, unbothered. So here's where I'll leave you, because this isn't a video that ends with a neat 5-step plan or a course you should buy. If a system can shrink your money every single year without ever sending you a bill, without a single vote being cast on your behalf, and it's been doing this quietly for over 50 years since one afternoon in 1971, then the real question isn't just how do I protect my savings? The real question is this. If nobody ever has to explain this mechanism to you directly, and it still shapes almost every financial decision you'll ever make, what else is running in the background of your life right now that you've simply been told to call normal?